Okay, all right. And that was a take coming in from the management earlier. Let's go back to the market conversation. We have Varun Goel joining in with some perspective on the market. Varun, great to have you on. Thanks very much for being with us. We have to start the conversation with IT, right? Because while you can blame the companies that were not showing growth or had a fall in growth, today's market reactions are also fairly sharp. I mean, what's your take on the sector? Do you have any exposure? Would you try and be a contrarian here and maybe buy the dip?
Yeah, good afternoon, Surbi. Thank you so much for having me on the show. I think we remain constructive on the large cap tier 1 IT names. If you look at the valuations, they're almost at a 10-year average valuation. I think most tier 1 companies are trading at 4 to 5 times free cash yield, and that remains attractive. One hopes that with the US growth continuing to hold up, the second half of the year should see better deal signage and better volume growth. I think as far as the mid and the small cap space is concerned, that continues to be headwinded. I think the starting valuations continue to be extremely high. So we'll be a little careful on the mid and the small cap IT space. I think there's some small niches like the healthcare BPO space, which seems to be growing a lot faster, which still remains attractive. But other than that, we would be cautious on the mid and the small cap IT.
So IKS, Agility, these are the companies you like?
So Rima, I would not be able to take any names, but broadly, the healthcare BPO vertical continues to be a fast-growing space.
Okay. And large cap IT, valuations are okay, and you're expecting growth to come back in the second half of the year, and therefore you're fairly optimistic about large cap IT, correct?
Yeah, we remain overweight on some of these large cap names, yes.
What has been your read of the earnings season outside of IT? If you could just take it, sector by sector, what were your key takeaways?
I think so far, of course, earnings growth have been a little muted. I think for the year, of course, we expect 10 to 12% kind of earnings growth. There is, of course, an expectation that with so much of monetary stimulus that we have seen from RBI and yet some more may come, and you combine that with the 1 lakh crore of tax cuts, second consecutive good monsoons, various attempts being made to revive consumption demand. I think broadly we should see a good festive season, and therefore we remain quite hopeful that for the year as a whole, we'll go back to the 30-year average earnings growth for Nifty, which is around 11-12%. It is the small and the mid-cap space, which was very badly beaten down last year. I think the small cap segment had minus 15% kind of earnings growth in FY25. So that is a space where we expect a much stronger 20% plus kind of earnings growth. And hopefully, I think starting from the September-October month, we should see much better earnings picture coming in.
Sorry, and which sector did you say it'll show up in the most explicit way? This 20% growth that you said?
Yeah, so see, if you look at, there are 3 large sectors which showed earning declines last year, or where earnings were under pressure. I think refining cycle was clearly in a downturn. So oil and gas refining companies saw large cut in earnings in FY25. On that low base, we expect things to bounce back. Metals clearly, with the benefit of anti-dumping duties and all, that sector will show strong earnings growth. And the third is the financial space. If you look at the overall MFI, NBFC, small bank space, that is the space which was hurt really badly because of the write-offs and provisioning which happened in the second half of last year. On that low base, again, the numbers should get back up significantly this year. So that is the reason why the small cap earnings were down last year, and which should look a lot better this year.
Got that. Varun, just request you to stay on. We want to just get a quick handle on what's happening in the futures and options market. Today is also the weekly expiry. Mangalam is joining in with a 3 p.m. check on the futures and options market.
So as you move towards the 3 p.m. mark for the market, there is a decline that we are seeing in the frontline indices, the Nifty Bank, as well as the mid-cap index, all of them under a wee bit of pressure. But as we move towards 3 p.m., just keep an eye out on a couple of these strikes which are fairly active in trade. Even as the India VIX has moved higher, we have the 25-100 call, which is extremely active. That has a premium of almost 10 rupees, telling you that the street believes that maybe 25-100 is not a mark that the Nifty can go ahead and cross. 25-100 put writers equally active in today's trading session as well. So if you are writing the 25-100 call and put, the street is believing that the rough range for the expiry that happens 30 minutes from now would be close to 25,075 to 25,125 itself. Were we to break that, then 25,050 is the level that we have to keep an eye out on very closely as well. Keeping a watch on some of the PSU banks which are doing well ever since Canara Bank reported its numbers. So there's short covering that's taking place in Canara Bank, but Indian Bank and Bank of Baroda, both of them have seen a lot of long build-up, and Bandhan Bank is one of the stocks that I'll watch out for, as the threshold for it to exit F&O ban is very close. So if we see some open interest decline, then maybe this evening we get the news that Bandhan Bank is out of F&O ban.
Okay, all right, got it. Thanks for that, Manglam. Interesting. So, yeah, that explains the green that we're seeing on some of these PSU banks today. Varun, going back to you, talking earnings, what are you liking in financials? It's a very large space. So is it more private banks? Is it PSU banks, mid-tier banks? Because this earnings season at least has told us again that safety is with the big boys. The mid-tier banks still have issues around asset quality or credit cost in some cases.
Yeah, I think we continue to like both the banks and NBFCs. I think NBFCs will be the first ones to start showing benefit on the NIM side, because the interest rate cuts will get passed far quicker. I think also with so much of rate cuts and monetary easing, we expect credit growth to start reviving. As of now, we are running at 9-10%. Our sense is by the festive season, we should be seeing system-wide credit growth going to 11-12%, and some of the large banks, both public and private, can grow at, let's say, 14-15%. So I think Tier 1 banks will continue to do well. Some of the smaller private banks, small finance banks are trading at fairly attractive valuations. And I think the credit cycle continues to be under control. We do not expect large slippages on the retail loan book side. And that segment also continues to be attractive. I think NBFCs, again, we expect strong earnings growth because the credit momentum is clearly there, and that should continue to hold. So I think broadly, this is a space which is most reasonably valued. And the earnings growth, secondly, especially in the second half of the year, should look pretty strong.
All right. Hi, Varun. Good to see you again. Well, one segment that's actually given good set of numbers is cement. And the commentary has been encouraging as well. But the stocks have already run up. And it seems, in FY25, they didn't deliver. And the stocks didn't correct. But post that, we saw a run up in the stocks. And now they're not reacting very favorably to the numbers. Case in point being a Dalmia Bharat, a Sagar Cement, a Nuvoco. All of them reported excellent numbers. But the stocks have not moved too much. Second half of the year, though, could be far better. Your pecking order among these names?
Good afternoon, Nigel. I think we remain constructive on the cement space. I think last year was tough from a margin point of view. There were significant headwinds from a raw material perspective. Pricing was also under pressure. I think this year there are some very feeble signs of pricing revival, but raw material scenario is definitely a lot better. So we expect significant improvement in EBITDA per ton for most of the Tier 1 cement companies. Our preference, though, remains with the larger names where the pricing power is a lot better. And because of the significant consolidation which is happening in the sector, we hope that once the monsoons are over, the pricing outlook would also get healthier. So we will prefer the Tier 1 names in the space.
Varun, thank you very much for joining in. Need to slip into a break. On the other side, we'll get you a check on the dealing rooms.